If you have ever signed an application for a big insurance policy,
Hmm.
disability, accident, and sickness, that kind of thing, you know that feeling.
Oh, yeah.
You sign on the dotted line, and you're just like, okay, phew, done, I'm covered.
Right.
But that signature, it isn't the finish line. It's really just the starting gun for this incredibly complex process inside the insurance company.
A whole other world kicks into gear. Yeah.
Exactly. So today, we are doing a deep dive into that black box insurance underwriting to really understand how carriers assess your risk and, well, how they decide if you're worth the gamble.
And that internal process is, it's absolutely necessary for the insurer. Underwriting is this really sophisticated mechanism. It's designed to prevent, undue risk exposure
To the whole pool of money.
to the entire capital pool. It ensures the rates and the policies stay viable and fair for everyone else who is already insured. We're looking at some sources today that just meticulously break this whole matrix down.
So our mission today is to take you inside that matrix. We're going to unpack the medical and the financial checks that determine your eligibility.
And we'll explore some surprising macro factors, things like investment returns, even lapse rates, that actually set your premium.
And then we'll walk through the absolutely critical and I think often overlooked legal steps that are required to make your contract officially binding.
It's a fascinating subject. So much of it is just counterintuitive.
It really is. Okay, let's get into it. So when an insurance company looks at an applicant, they aren't just looking at one thing. They're using two distinct lenses.
The dual pillars of risk assessment.
The first one, and maybe the one that's most surprising to people, is financial underwriting.
Right, and financial underwriting serves a couple of really specific purposes, especially for things like disability insurance. First, they have to verify your income.
Why?
Well, it's fundamental. That number sets the maximum coverage amount you're legally entitled to. It makes sure you aren't, financially better off on a claim than you were when you were working.
Okay, so that's about the claims side. But there's another reason, right? It's about the cost of just issuing the policy in the first place.
Exactly. They have to determine your ability to pay the premium over the long term. Issuing a new policy is expensive for the carrier. You've got medical exams, admin costs, commissions,
So they're putting money out up front.
a lot of it. And it often takes several years before the company earns back those costs and hits what's called a profit position, or the crossover date.
Wait, what exactly is this crossover date? Why do they care if I keep paying my premium until then?
The crossover date is that exact moment in time when the total premiums you've paid in finally exceed the total costs the company has put out to, acquire and maintain your policy.
Oh, okay.
They need some reassurance that you can keep paying at least until that date, just to mitigate their initial investment in you.
So if a bunch of people cancel early, the insurer loses money.
And that affects everyone's rates down the line.
That makes perfect sense. Okay, so that's the money side. The second pillar is the one we all know a little better, medical underwriting.
Medical underwriting is simpler in its goal. It's to determine if the applicant is an acceptable claims risk from a health perspective.
Simple as that.
This is where they decide if your known history or just the general risk is too high to insure at standard rates, or maybe at all.
So while those two pillars decide if you get coverage, there are these other factors, many of them completely outside your control, that set how much you pay.
Yes, and that raises a great question.
Right. If I'm a perfectly healthy applicant, why is my premium being affected by something like the global investment market?
That's where the macroeconomic reality of the insurance business really comes in. Insurance is a promise, and that promise relies on huge, huge calculations.
So we have 5 core factors that really move the needle on premiums for these kinds of products,
Let's start with the two obvious ones on their balance sheet.
which would be administrative costs and morbidity rates, the risk of getting sick.
Precisely. Admin costs are, staffing, marketing, keeping records. If those go up, premiums go up. And morbidity rates, that's the fundamental rate of illness or injury in the population. More risk, more claims, higher premiums.
Okay, so that's costs and risk. What about the income side of their equation?
That's number 2, investment returns. Insurance companies hold these massive capital reserves, and they invest it.
The money they haven't paid out yet.
Exactly. And higher returns on that capital lead directly to lower premiums because the company can offset claims costs with its investment income.
Okay, now let's hit the one that always surprises me. Lapse rates. You'd think policies ending early is bad business.
It absolutely feels backward. The lapse rate is just the number of policies that get terminated because someone stops paying.
And from an actuarial standpoint.
From an actuarial standpoint, higher lapse rates can lead to fewer potential claims and, paradoxically, lower premiums for everyone else in the pool.
Wait, hold on. So if enough people quit paying their insurance, my bill might go down. That just feels wrong.
The logic is cold, hard math. The policyholders who lapse are no longer potential claimants. They're off the books. So that reduces the overall exposure of the risk pool. Plus, there's a behavioral pattern there. People who lapse early often believe they're healthier or at lower risk, so statistically, they might have been lower risk claimants anyway.
That is just fascinating. Okay, and the fifth factor deals with non-standard risks, ratings and exclusions.
These are the tools an insurer uses when an applicant doesn't quite fit the standard profile. A rating just means a higher premium. An exclusion means they won't pay for specific conditions.
And because those tools limit the insurer's risk.
They protect the claims pool, and that helps keep premiums lower for all the standard applicants.
This brings us back to morbidity. You said actuaries use these massive data sets called morbidity tables. So how reliable is this crystal ball, really?
Well, these tables are very good at predicting the frequency of disability in the general population. They work with millions of data points.
Predicting how many people of a certain age and gender will likely become disabled.
Right, the causes, the duration, all of that.
So is it sort of like predicting traffic in a big city?
That's a great analogy. They're excellent at predicting citywide traffic volume, the general population risk. They can predict the number of accidents.
But not the cost of each accident.
Exactly. They don't predict the specific dollar amount of exposure per claim. That depends on the individual policy. And here's the kicker. They are less reliable when you're trying to predict disability within a much smaller population.
Like the specific group of people insured by just one company.
Precisely. If an insurer's client base is heavily weighted towards, say, construction workers or something, their claims history might look very different from the general tables.
Which brings us back to the financial side and the idea of anti-selection.
A huge risk they have to mitigate. It's why they restrict how much coverage you can even buy.
So the biggest risk isn't just that I might get sick, but that I might be a little too comfortable after I get sick.
That's the moral hazard they're trying to prevent. With disability coverage, the amount you get is strictly limited to a percentage of your pre-disability income.
From all sources.
From all sources. The core idea is to make sure you're never better off financially on a claim than you were while working.
Because if the benefits are too high, the incentive to go back to work just shrinks.
And overinsurance could lead to anti-selection. Someone might file a fraudulent claim or, more commonly, just prolong a valid claim longer because the benefits are better than a paycheck.
Which drives up the cost for everyone.
That's the bottom line. So if they do have to insure someone with a higher risk, say a pre-existing condition, they'll just use those tools we talked about.
Ratings and exclusions rather than just saying no outright.
It's the pragmatic approach. They manage the risk by charging a higher premium or by adding an exclusion for that specific condition. The person still gets insured for everything else.
Let's shift gears to the actual medical vetting process. The application you fill out is just the start. The evaluation goes way deeper.
It really does. The first key source is what's called an attending physician's statement, or APS. The insurer might just ask for a report from your family doctor or a specialist you've seen.
And what triggers that? Is it automatic?
It can be both. It might be automatic based on your age or, the amount of insurance you're applying for. Or it could be triggered by something you mentioned in your application.
And who pays for that?
The insurer does. The request goes from their head office straight to the doctor, and the insurer bears the cost. It's a significant expense for them.
And they can ask for more than just doctor's notes, right? Like a physical exam.
Oh, absolutely. They might request a paramedical exam, blood work, urine tests, maybe an ECG, just to get a current, objective snapshot of your health.
Okay, the second big source is the Medical Information Bureau, the MIB.
Yes.
What's so fascinating here is that the MIB data isn't used to underwrite you directly, but to send up red flags. Why is it so secretive? They just share codes.
Well, the MIB is a central clearinghouse for the whole industry. Insurers report and seek coded historical information. They use codes specifically because they don't want the database itself to contain sensitive medical records.
Ah, for privacy.
Right. The MIB data just gives general markers that might indicate a history of a certain condition or a prior refusal of coverage. That then triggers the insurer to go get more specific information, like that APS.
So it's an integrity check. It stops people from hiding past problems.
That's it, exactly. They're protecting against applicants who might try to overinsure by going to multiple companies or who just don't disclose a known medical condition or a prior decline.
So you can't get declined by company A and just run over to company B and pretend it never happened.
Not without it flagging the system, and you have to sign a specific authorization allowing them to check the MIB before they can even proceed.
Okay, let's move to the end game. After all this scrutiny, you've been approved. But the policy still isn't legally binding. The physical delivery of the contract is the legal climax of this whole thing.
Right, so the process starts when you submit your application. Legally, that's called an offer to treat. When the insurer issues the contract, that becomes the formal offer.
And the policy is only in force when the applicant accepts that offer.
And there's an exchange of consideration.
Consideration just means the premium payment.
Yes. The policy is officially active once you've accepted and paid that first premium, and this leads to the critical final step, delivery. The agent typically hand delivers the policy, and that delivery starts a very important clock.
The 10-day free look period.
That's right. It's a convention that gives you 10 days from the date of delivery to read it over and decide if you want to keep it.
And if you don't, you get a full refund.
Full refund. But crucially, that 10-day clock does not begin until the policy is physically delivered to you. The whole legal agreement is just kind of suspended until that physical policy is in your hands.
And connecting this to the bigger picture, the Provincial Insurance Acts have really strict criteria for a policy to be legally in force, especially concerning changes that happen between application and delivery.
Yes. There are 3 absolute requirements. First, the contract has to be delivered. Second, the initial premium must be paid.
And third,
And this is the part that so often gets overlooked, neither the financial situation nor the health of the insured can have negatively changed between application and delivery.
so the agent has to ask this almost awkward question at the moment of delivery. Like, have you gotten sicker or poorer since you applied?
They absolutely must ask. It ensures the coverage being delivered is still appropriate for the risk they thought they were taking on.
For example, if your income dropped,
If your income dropped, the disability coverage might now be excessive, and that violates the anti-selection rule we talked about. The policy would be delivered under faulty premises.
we actually have a great little anecdote that illustrates this perfectly. Tell us about Agent Todd in Lucille.
Right. So Agent Todd was delivering a critical illness policy to Lucille. They'd gone through the whole process. During that final delivery interview, Lucille admitted she had started getting chest pains, and it was later diagnosed as angina. But the key is, it started about 2 weeks after she submitted her initial application.
So he's got the policy, premium paid, ready to go, in his hand. What does he do?
He correctly took down all the details of the change, recorded his notes, and he returned the contract to the insurer for reassessment without delivering it.
Wow.
If he had delivered that policy, it would have legally been in force, and it would have obligated the insurer to a risk they had never even assessed. He protected everyone involved.
It's important to clarify the difference here between a negative and a positive change.
A huge difference. If your health has declined or your income has gone down, that has to be reported. But if your income has increased since the application, the advisor is not required to report that.
The risk is now on you, the insured, who bought less coverage than you might now qualify for.
Exactly.
So dealing with these rated policies, where the insurer slaps on a higher premium or adds an exclusion, that's got to be one of the trickiest parts for the agent.
It requires a lot of honesty and perspective. A good agent, if they suspect something might lead to a rating, will mention that possibility up front.
So it's not a shock at the end.
Right. But at delivery, the agent just has to gently reinforce that the original reason for buying the coverage hasn't changed. In fact, now that new risks have been identified, the need is arguably even greater.
Beyond just handling the rating, the agent has to do a full contract disclosure. I mean, clients aren't lawyers.
No, and they're not going to read the dense policy language, so the agent has a duty to explain the key elements clearly.
Benefits, limits, riders.
Key definitions. But they have to pay particular attention to exclusions. These are often added by the insurer's head office after the underwriting review.
So the client needs to know exactly what coverage was taken away.
To avoid a major conflict down the road at claim time, absolutely.
This raises one final layer of complexity. Even with great coverage, there are statutory limits on the total payout to prevent over-reimbursement. You can't profit from an accident.
That's the rule across the industry. Where contracts overlap, you can't be reimbursed more than once for the same loss. Benefits can supplement, but not duplicate.
So for disability, total coverage from all sources is usually capped at around 85% of your income.
Right. Can you give us that quick example with Jorge?
Sure. So Jorge has a group plan that pays $2,500 a month, which is 50% of his salary. The maximum he can recover is 60%, or $3,000.
So he can buy an individual policy to top up his benefits to that $3,000 max, but he can't legally collect more than that combined total from both policies.
But it's different for critical illness, which is a lump sum.
Completely different. With CI policies, there are no specific limits on the amount of benefit because it's not tied to your income or expenses. It's a lump sum trigger.
Okay, last thing. During this final delivery meeting, the topic of taxes always comes up. Can I deduct my premiums? Are the benefits taxable?
And agents have to be extremely cautious here. The agent is generally not an accountant or a tax lawyer. They're stepping outside their expertise by giving specific tax advice.
So what should they do?
They have to discuss the potential tax treatment during the recommendation phase, but they must always refer the client to a qualified professional for advice on their personal situation.
So we have journeyed through this entire matrix. From the 2 underwriting checks, financial necessity and medical risk, to the 5 macro factors that actually set your premium.
Including the very counterintuitive impact of lapse rates.
We explored the protection offered by the MIB and, critically, that legally precarious period between application and the agent's physical delivery of the policy.
You know, we often think of insurance as a contract based just on our immediate health, but the rigor of this whole process, using morbidity tables based on millions of lives, coordinating benefits to prevent anti-selection, checking affordability, it shows that the price and the legality of your policy are determined not just by you,
But by vast actuarial risk, the performance of the stock market.
and even the speed and diligence of the agent delivering your contract.
So given the critical importance of avoiding a negative change in your health or income between applying and receiving that policy, consider this. What level of detail should you proactively track and be ready to disclose? And how does knowing that risk period exists change your life decisions once you've submitted that application? Something to mull over until our next deep dive.